If 2025 was the year of big surprises, 2026 is shaping up to be the year of policy divergence and hard asset demand. In this video, we'll walk you through our 2026 outlook for Euro USD, USD JPY, GBP USD, the Australian dollar, and also the silver market, which has become one of the most talked about assets going into the new year. Rather than focusing on short-term noise, this outlook is about the big macro forces likely to shape markets throughout 2026. Before going pair by pair, let's start with the main drivers I'll be watching in 2026. First is central bank divergence. The key question is who cuts first, who stays restrictive for longer, and who might be forced to stay hawkish. Second is the direction of the US dollar. If the US dollar remains soft, that tends to support risk currencies and metals. If it strengthens, it changes the whole picture. Third is bond yields and risk sentiment. Fast moves in yields can shift FX trends very quickly, especially in high beta pairs. And finally is geopolitics. Any escalation usually supports safe haven flows and hard assets. So the big question for 2026 is, does this year reward carry trades and risk on positioning, or do we see repeated risk off spikes that keeps market volatile? Starting with the euro, this looks like a classic grind higher with pullbacks type of market. My baseline view is that the euro USD trades mostly in a 1.16 to 1.2 range, with the market gravitating around 1.18. In a bull case, a sustained break above 1.2 becomes possible if the Federal Reserve cuts faster than expected, or if the US growth slows more sharply. In a bear case, the pair could slide back towards 1.1 to 1.15 area if risk-off conditions return, or if Europe tends to underperform. From a chart perspective, the 1.17 zone stands out as the most important support area, while 1.2 remains the headline breakout level to watch. How I'd frame it overall, in early 2026, we could lean towards a stronger euro if the US dollar continues to weaken, followed by consolidation once the market fully prices in the rate path. Next up is USD JPY, and this pair is all about the US-Japan rate differential and the Bank of Japan's direction. We expect bigger volatility in the first half of 2026, followed by a more downward bias later in the year if US rates fall and Japan continues to hike. A realistic working range to keep in mind is 150 to 155 as a central zone. In the first half of 2026, expect choppy price action, potentially between 152 and 156. In the second half of 2026, downside risk starts to increase with potential moves toward 145 to 150, and in stronger yen scenarios, it could possibly go even lower. There's some key points to remember that BOJ normalization supports the yen, but intervention risk can create sharp and sudden spikes. So if dollar yen rallies too far, the 158 to 162 area becomes an important intervention risk zone. So the simple takeaway is that USD JPY may shift from a strong dollar story to one of gradual yen strength if the rate gap continues to narrow. Moving on to the British pound, 2026 looks more range bound than strongly trending. The way to think about the cable is a weaker start and a stronger finish. If the market initially focuses on the UK rate cuts and then later shifts attention back towards the US dollar weakness. A practical equilibrium zone to keep in mind is roughly around the 1.29 to 1.32 zone, which swings around that range depending on data surprises. Key factors to watch include the UK growth and inflation progress, the pace of the BOE cuts versus the Federal Reserve cuts, and any fiscal headlines that affect confidence. So the key takeaway is that the cable might not be the cleanest trend trade yet, but it can offer some strong swing trade opportunities if you respect the range. Moving on to the Australian dollar, it's a classic risk and rates currency. So that if the RBA stays firmer on inflation while the US dollar remains soft, the Australian dollar can stay supportive for longer. Commodity prices and overall risk sentiment also matter a lot. If global growth holds up, the Australian dollar tends to benefit. The way I position, it's pretty simple. The Australian dollar is most sensitive to risk appetite, China and global growth, and the RBA's tone. So one key psychological level to watch is the 67-cent zone alongside your own chart-based support and resistance. The Australian dollar performs well in a stable to risk-on environment, but it's pretty vulnerable if the markets turn defensive. Now let's talk about silver because it doesn't really trade like a traditional metal. Silver behaves more like a mix of a hard asset and a high volatility instrument. The 2026 storyline is potentially a consolidation phase first, followed by a breakout. A wide range to discuss is the $60 to $80 range with potential for more spikes in more extreme scenarios. The key drivers for silver are pretty clear. First is Fed cuts and real interest rates. Falling real interest rates typically support metals. Secondly is industrial demand, particularly from solar, EVs, and some tech-related sectors. And third is liquidity and volatility because silver moves really fast. So position sizing is really important. Silver can deliver strong upsides, but it can also correct really sharply. So it should be treated more like a high volatility asset, not really a slow moving store of value. To wrap it all up, my approach for 2026 is pretty simple. First is to define the macro driver. Are we in a risk on or risk off environment? What are yields doing and where's the Fed path heading? Second is trade levels, not headlines. Key zones matter more than daily noise. And the third is use of proper risk management because 2026 could bring sudden volatility from policy shifts or geopolitical events. So we never know what's going to happen in 2026. That's the strategy or framework that I'll be using to navigate markets in 2026.